Valens Research, Uniform Financial Analytics.
Right, Incyte is a pharmaceutical company. They're a biotech company. Looking at Incyte's performance historically, what we can see is a couple key things. One, we can see on an as-reported basis, it looks like Incyte has barely been profitable in its history. It's been really profitable only 3 or 4 of the last 15 years. In reality, Incyte's ROA really has been profitable since 2012. Right? This is not a company that is a startup biotech firm that's still trying to find its way. This is a healthy, high return business that is really producing strong returns. But not only that, not only does the market misrepresent how profitable this business is, the market also makes you think that you are paying a premium valuation for a startup biotech firm. As reported metrics make it look like you are paying a 30 times multiple for a company that's had positive ROAs 4 of the last 15 years, and really 4 years in its history in general. In reality, you are paying a below market multiple, a 15 times multiple, for a company that has stable, high returns. Right? This is the kind of mind-blowing insights that you see when you're looking at as-reported metrics versus the uniform accounting metrics. Literally, you look at an as-reported metrics for them, and you think, I'm buying a startup and I'm taking a chance by paying so much for in terms of valuation for this business, when really, when you actually clean up the noise and you remove distortions for things like R&D, stock option expense, think about how this company is actually investing in its business, what you can really see is this is actually a phenomenally profitable business the market is way too negative on. I mean, look at it. At current valuations, right, this company has basically been able to grow its assets at 20% a year for the last 7 years, and also maintain ROAs relatively stably around 20%, as they're forecasted to do going forward too, based on sell-side estimates. But with the market's pricing in, yeah, you're going to continue to plow money into R&D, but your returns are going to fall by 3/4. Now, I have no opinion, and we at Valiance have no opinion about Incyte's future products under development, about their patent cliff, about any of those details about the business. We are not pharma experts, and we don't think that, and Incyte's not on our conviction long idea list because we haven't done that research on the name. But what we do know about Incyte is once we actually look at the uniform accounting data, we know that we've got a phenomenal margin of safety here. This is not a highly expensive business where we're betting on the future. This is a company that is a high return business where basically we can buy it pricing that its future isn't existent, right? That it's actually going to fail in every single attempt it makes over the future to develop a new drug, and its current drugs are going to vanish, right? Basically, that's what we're pricing in, because what we're pricing in right now with 20% asset growth and ROA falling by 5% is basically this company is going to be 2 times as big in the next 5 years, but it's also going to have half the profitability that it has right now. That's what you think about it. And so if we look at this a different way, right? If we just say, hey, this company's never going to grow again, we're basically going to write off all the R&D that they're going to invest because of the fact that we think it's worthless. And then we're going to say, so what does this business have to generate? If this business never grew again, which it's going to grow, right, ROAs would still be projected to fall from 18% to 12%. That's a pretty phenomenal drop. But if we say something more reasonable, let's say that we think that growth is going to continue, but it's going to be around 15% instead of the legacy 20%. And also, because their next drugs aren't going to be as profitable as this one's, let's actually do think that they're going to have ROA plateau around 12% levels. Well, what do we see if we look at that? This company has 75% upside. Now let's just really quickly sanity test that also. What I'm going to do here is I'm taking you over to the quality to valuation scatter. This is a really good way to benchmark a company versus its peers. So what you're looking at here, and I'm just going to remove some of the outliers here, and I'll explain why in a moment. What you're looking at here is the uniform accounting ROA for these companies versus the uniform accounting valuation these companies trade at relative to their asset base. Right? So ROA is the X line as the X axis. Valued asset prime is the Y axis. Why? Because valued asset prime, the premium the market pays for a company, is directly dependent on where that company actually, what the kind of returns the market expects for that company. So now what I'm going to do really quick is I'm going to say I just want to look at United States firms that are in biotech and pharma right? And I want to look at companies that are also only really above, I'm going to say above a $5 billion market cap, because we want mature businesses like Incyte. I'm going to apply these filters. What I'm going to do is I'm going to get a scatter of a lot of companies here. And then what I'm going to do again is I'm just going to remove these outliers and just look and say, okay, where are the real normal returns bunched up for these companies? An average peer for Incyte, where is its return? And what I can see is they're really bunched up. The vast majority of these are between, call it 12, 13% for Lilly, and call it, right, 30% for Biogen. So when we're pricing in returns to fall to 12%, we're basically saying for your mature peers, we're expecting you to fall to the low end of mature peer profitabilities and also continue to grow at a slower rate than you have. When I look at that, this looks pretty low expectations for the company, and still this means the company's almost doubling, right? These are kind of insights that we can see that you wouldn't even think of looking at. If you were looking at as reported metrics for Incyte, you'd have thrown this idea out a while ago, because you'd have said, yeah, it's a startup biotech with high valuations, who cares? In reality, anything couldn't be truer, further from the truth.
Valens Research, the world's leading source for uniform financial analytics.